OpenAI has signed thousands of agreements, building artificial intelligence infrastructure across more than 30 states and countries. In just 1 year, AI-related deals have approached $1 trillion in total value. To sustain this rapid expansion, the technology industry has entered a global race to build data centers at a speed not seen since the early growth of the internet. Major companies are investing at an unprecedented scale. Meta plans to spend hundreds of billions of dollars on massive AI infrastructure projects. Across the world, data center spending is expected to double before 2030, driven almost entirely by artificial intelligence demand. AI compute alone could exceed $1 trillion in total spending by the end of this decade. However, most of these projects are not yet generating profits. Companies are relying heavily on future demand to justify current investments. Investors continue to show strong confidence, believing that artificial intelligence will deliver significant long-term returns. At the same time, concerns are increasing. More than half of large fund managers believe that AI valuations show clear signs of overexpectation. While AI spending has already contributed to economic growth, questions remain about how sustainable this expansion really is. In the AI economy, capital is not evenly distributed. Instead, it circulates among a small group of dominant companies. Artificial intelligence has quickly become central to the global technology landscape. AI-related companies now account for more than 30% of the S&P 500, reflecting their growing influence in financial markets. In 2025 alone, some major technology firms invested over $300 billion into AI infrastructure. This level of spending is unprecedented in the history of the tech industry. Unlike previous technological revolutions, the AI boom is concentrated in a handful of powerful companies with the financial and technical resources to lead it. From this structure emerge what analysts describe as circular deals. These are agreements where companies finance each other, supply each other, and depend on each other for growth. NVIDIA plays a central role in this system. It designs and sells advanced chips, invests in AI companies, and benefits from the demand it helps generate. A large portion of its revenue now comes directly from data center operations. Cloud providers such as Amazon, Microsoft, and Google purchase these chips in massive quantities. They then rent computing power to businesses, developers, and AI startups. At the same time, companies like Oracle lease computing capacity, while also purchasing hardware from the same ecosystem. This creates a tightly connected network of investment and consumption, where money flows continuously between the same key players. While this system supports rapid growth, it also creates structural risk. If one major company slows down or faces financial pressure, the impact can quickly spread across the entire network. The physical backbone of artificial intelligence is expanding rapidly through data centers. These facilities already consume nearly 3% of global electricity. In some regions, their energy usage is comparable to that of entire cities. By 2030, AI data centers could account for up to 12% of total electricity consumption in the United States. This surge in demand is placing significant pressure on energy systems. Companies are securing long-term power agreements to guarantee stable electricity supply. The growing demand for energy is also contributing to rising electricity costs in some regions, affecting both businesses and households. In addition to electricity, data centers require large amounts of water for cooling and ongoing maintenance. Unlike software, this physical infrastructure becomes outdated quickly, often within a few years, requiring continuous upgrades and reinvestment. Despite the rapid growth of AI services, profitability remains limited. Many AI companies are generating revenue, but their operating costs are increasing at the same pace or even faster. In some cases, expenses are growing up to 25% faster than revenue. Analysts estimate that the industry would need hundreds of billions of dollars in additional annual revenue to achieve even modest levels of profitability. For several major companies, meaningful profits may not arrive until the end of the decade. This situation has led to comparisons with the dot-com bubble of the late 1990s. During that period, massive investments were made in internet infrastructure before sustainable business models were fully developed. When expectations collapsed, trillions of dollars in market value were lost. Today, artificial intelligence shows similar patterns, including heavy upfront investment, high market valuations, and business models that are still evolving. However, there is a critical difference. Artificial intelligence is deeply integrated into the global financial system. The largest AI companies now represent a significant portion of stock market indices, pension funds, and institutional investments. This means that any major correction would not only affect technology companies, but could also impact the broader global economy. Despite these risks, investment continues to accelerate. AI startup funding exceeded $120 billion in 2024, and major corporations are planning even larger investments in the coming years. Artificial intelligence has become both a transformative technology and a financial system driven by expectations. A small group of companies now controls the majority of global AI spending. Their continued growth depends on maintaining a constant cycle of investment, innovation, and expansion. Each investment reinforces the next, each contract supports future growth, and each new data center strengthens the overall system. Artificial intelligence will remain a central force in the global economy for decades to come. However, the key question remains: can this trillion-dollar momentum continue when expectations must eventually be supported by real, consistent, and sustainable profits?